So now we're going to look at what $200 per month can do for you in a life insurance policy. The commitment. For a fixed contribution, you are securing an asset with 4 distinct dimensions of utility. This is not just a monthly expense. It is the funding mechanism for immediate estate creation, protection in the event of qualified critical health emergencies, tax advantage growth, meaning that it grows tax-free and that it is distributed tax-free, which is not true of a 401k. And there's also the ability to take policy loans on very, very favorable terms. Now, dimension 1, immediate estate creation. From day one, your legacy is secured. A tax-free sum paid to your beneficiaries, ensuring their financial stability regardless of market conditions. Dimension 2, the safety net. 3 different types of illness. Chronic illness is when a person cannot perform 2 of the 6 activities of daily living. So that means walking, dressing, bathing, eating, and so forth. Critical illness is a number of illnesses. The big 3 are heart attack, cancer, and stroke. Another one is major organ failure, and another is kidney failure. I believe this is incorrect where it says major burns. Terminal illness is when a person has been diagnosed with 12 months or less to live. And in all these cases, a person is eligible to claim up to 80% of the death benefit while they are still alive. That's what we know as living benefits. Life insurance that you do not have to die to use. Dimension 3, if you're putting your money somewhere, how would it be nice to win when the market is up, but not lose a dime when the market is down? Unlike stocks, unlike Forex, unlike crypto, and unlike the 401k, the cash that you put in this wins when the market does win. But when the market goes down, as you can see here, this is what your life insurance policy does. It returns 0%, not a negative percent. Okay? So when you're putting money in something for decades, that's the type of stability that I would look for. Because if anything goes down, it requires a greater percentage gain just to get back to where you were. With life insurance, you never have to get back to where you were because you have a contractually written guarantee that the lowest return for any year will be 0% or greater. Here you can see the ramp-up years of your policy. First 10 years, you're pretty much funding the death benefit of the life insurance policy. But by year 5, you're starting to gain some traction and having some funds that's available for you to make policy loans on. You can borrow that money. And by year 10, you've got almost 20K sitting there available for borrowing. And borrowing from a life insurance policy is a very powerful thing that we'll get into in one of the slides at the end. The wealth window, years 20 through 30. Here we see, as the policy matures, that the accumulation accelerates. And by year 30, the accessible cash value is around 130K. Okay? And that, again, that cash value, you can take policy loans on it. We're going to get into the power of taking loans from a life insurance policy as opposed to anything else. We're going to get into that in one of the later slides. Okay? And all this is for $200 per month. Dimension 4, liquidity and access. Borrow against your accumulated cash value for any reason, without credit checks and without bank approval. And guess what the charge is for borrowing? 2% per year. Per year. Yes, that is phenomenal. I don't know of much else that's better. But it does get better when you take a loan from a life insurance policy. And we're going to get into that a little bit later. So, you see the power of and. A complete strategy for $200 per month. For $200 per month, you immediately secure a $300,000 death benefit to secure your loved one's future. And for $200 a month, financial support during serious qualified illnesses. And for $200 a month, the potential to acquire $130,000 of cash value. Please understand that this estimate is based on the past 25 years of performance through COVID, through 9/11, through the 2008 housing bubble burst. Now, past performance is absolutely not a guarantee of future gains. That's why that figure of $130,000 is known as a non-guaranteed value. Yes, it did happen over the past 25 years that it showed that strength, but that is absolutely not a guarantee for the future. And finally, for $200 a month, you can access this accumulated value when needed without interrupting the growth of your savings. Okay? I don't know of anything else like that. A money market fund, 401k, all of these other vehicles, when you borrow from them, you have less capital that's attracting compound interest. When you borrow from a life insurance company, the life insurance company gives you their money, not your money, which means that your money continues to attract compound interest. No interruption on the growth of your account when you borrow, and no interruption on the growth of your account during market collapses, because you have a guaranteed 0% floor. It's been very exciting to share the power of what $200 per month can do for you in all of these 4 dimensions. Thank you for your time.